We talked about, how we were concerned about the data. We were reducing risk. We were reducing equity. We were hedging. When we got some of these rallies, we've been selling even more. So we're probably at our lowest equity exposure I think we've ever had. So we're still very concerned.
So you think this goes pretty sour?
Yeah, I think the news just keeps getting worse, right? And so I think from our standpoint, until the story changes, the most important thing for us is price. And so until price gets down to a level that we feel comfortable with, we're going to continue to remain defensive.
Come on, even the guy at your shop, right, Mike Wilson, was suggesting that you could get a pretty good rally in stocks before, it all comes home to roost eventually. But, he's been as bearish as they come, and even he thinks you could have some pretty decent upside.
Yeah, I think if you look at the note, I think Mike is speaking to two specific things. One is the market is very one-sided. I was just in Las Vegas at a conference for Forbes and Shook, and there was nobody that was positive on the market, right? And that type of negativity, you only need a spark for the market to move in the other direction. That's number one. Number two, there's a good chart that we've been following, which is the 10-year versus S&P 500. Mm-hmm. And the bond market has done a really good job of leading the equity market. And we're in a situation right now where the 10-year is probably a little extended versus the S&P. So whether Jeff Gundlach's right or whether it's a situation where the S&P is going to catch up to the bond market, which would be even worse, we could see a situation where we could get another one of these bear market rallies.
But you think this is the biggest game and the only game in reality in town? Is the movement of the 10-year, if not the 2-year, right? Pushing 460. That's the biggest game in town over earnings, which have been pretty good, probably surprising you like many.
Well, I think since April when I was last here, earnings have come down about 10%, right? So expectations have come down fairly dramatically. The big problem for earnings is going to be next year, right? So right now we're projecting about 212 on S&P 500 earnings. That's about 20% lower than the street. So I think you've had this right when somebody talks about PE being cheap, the PEG ratio is looking good, equity risk premium looking good. The problem with all of that is if earnings going forward are wrong, none of that matters. And in our view, next year's earnings are going to be pretty bad.
So as little exposure as you have to equities, as you just said, might be the lowest you've ever had. Are you looking for more opportunity in credit, or are you kind of sitting out and as much cash, if not more, than you've ever had as well?
Well, yeah. You were talking to the professor about bonds and equities right now. The short-term Treasury right now is looking very attractive.
To everybody, though. It's like kind of what you were saying before. If everybody's in the same boat, is it really a boat to get in?
Well, the benefit of a short-term Treasury is the fact that you've got maturity, right? So maybe it fluctuates up and down, but if you're short enough, you're going to get your principal back. If you're looking at equities, which are discounting the future, and the future doesn't look bright, you want to be defensively positioned. Because remember, investing is geometric. It's not arithmetic. You get penalized more for losing money than you're rewarded for making money. So this is a period for caution.
Some are worried that, things can get a little asymmetric. To continue that analogy, given what's going on in the bond market with the volatility and liquidity, how do you see that?
I think that's a big problem. I think, the big thing that I'm concerned with is the dynamic within the bond market. So what is liquidity looking like? And you're hearing different things about concerns around different parts of the bond market that are becoming less and less liquid. And so that's something that we're particularly concerned with. So I don't necessarily think you want to be a hero here taking on credit, going into high yield. We haven't seen the bankruptcies. We haven't seen the defaults that you would typically see at this stage of the cycle. So from our standpoint, just continue to remain defensive.